Hello class. So we're going to be working on non-controlling interest here. What is non-controlling interest? That's when the parent, the controlling parent, doesn't own all of the subsidiary. So in consolidation, we take all of the assets and liabilities of the two firms, the parent subsidiary, and add them together and report them as a total. But that's misleading because the parent doesn't own all of the subsidiary, even though all of the subsidiary is reported in the financial statements. All of the assets are both of them. So we address that by removing the non-controlling interest portion of the subsidiary in a credit account on the balance sheet that kind of offsets those net assets that are owned by an outside party. So we used to call this minority interest. So if you hear minority interest or minority shareholders, that's an old term for non-controlling interest or NCI, and they mean the same thing. So let's have a look. So anytime the subsidiary has earnings or dividends, though part of that will belong in NCI because part of that goes to the other party. The parent, the other party has no access to. So the parent is always 100%. So we have to study the subsidiary to figure out the activity going through that NCI account, non-controlling interest account. So let's have a look at this data and see if we can kind of walk through how that works. So Beckman owns 60% of Calvan, and that costs $36,000. And so they have control, but there's an outside owner that owns the other 40% of Calvan. So Calvan has one asset at the time of acquisition, a special machine with book value of $10,000 and no liabilities. And then the machine's fair value at the time of acquisition was $50,000. So they would have a $40,000 fair value over book value that would be amortized over the life of the 10 years here. And then at the acquisition, anything above that $40,000 would be attributed to a trade secret. Okay, that would be amortized over 4 years. The acquisition fair value of Calvan was $60,000. Okay, so Calvan has one asset of book value of 10, so the book value of and no liabilities. So the book value of Calvan was 10, so that's a $50,000 excess fair value over book, of which $40,000 goes to the special machine, and so the other 10 goes to the trade secret. And that's kind of the work of chapter 3. So that part is really not new here, although it's a good review. But at the end of the first year now, we have these new balances down here. And so notice the special machine is no longer 10 because a year has happened, so I guess they depreciated it 1,000. They now have some new assets they didn't used to have. Okay, that's fine. And then this is the revenue and expenses that they earned, that Calvan earned during the year. And all of this is going into the consolidation, but we have to back out the NCI portion of it because they don't all belong to the consolidated entity. All right, so what is it that they want? The first thing they want is what is the NCI portion of Calvan's income. So Calvan's income is $30,000, but we have to adjust for the depreciation amortization on that special machine and the trade secret. So let's do that. So I've got some labels in here so make it easy to follow what we're doing. Okay, so we start off with the net income that they give us of Calvan. And now we have to depreciate that excess of fair value over book value for Calvan. And I do this at the 100% level, and then at the very end, I take the NCI portion percent. You can do each line times the percent if you like. Okay, so they both work, but be very attentive to whether you're working with the 100% number or the outside interest 40%. Okay, don't mix and match 100% with the 40%. Okay, so stay disciplined and organized and alert to, am I doing the whole thing? So this is the whole thing. And now I'm going to do the whole thing. So that whole 40,000, which was the difference between the 50 and the 10, over the 10 years. So each year there would be an additional 4,000 of depreciation. And then that trade secret of the 60,000, 50 went to the special machine, so the remaining 10 went to the trade secret over 4 years. So, and that should be minus. Those are a reduction of income. So let's fix that. Okay, so then this is the net income to be consolidated, is that whole thing. Now that's Calvan's total net income. And they get, the non-controlling interest is 40% of it. And you could have also just taken 40% of each of these lines and then added that up. So if that's a better practice for you, you can do that. Just be very careful about being confused and doing it for some of the lines and not all of them. Okay, so just heads up there. Okay, now in number 2, they want the balance sheet amount. So the first one was what portion of it is going on income statement, but NCI, similar to a retained earnings kind of account, is a credit equity kind of account. It's an outside interest account, so it doesn't belong in the equity of the consolidated entity. So it accumulates over time. And so what they want is, what is it right now? So let's build it. So I set up some column headings here. And in order to just be very explicit about the 100% versus the 60% versus the 40%, I'm going to show all the columns here for those of you that would be really helpful. So the initial purchase price was the 60, and the parent was 60% of that. Non-controlling interest is 40% of that. Sometimes the non-controlling interest is not proportional to the parent, and so they just tell you non-controlling interest was worth $26,000 or something different, in which case you use it. But if they're silent about it, it's considered proportional. So you could have taken the 36 divided by the 0.6 and gotten the 60 to see that the value of their proportionate shares is assumed to be in balance. Okay, net income for the year, which we got, of which the parent would have 60% and NCI would have 40%. And the way that the 14.1 works is you start with the 23.5 and you'll back out the 9,400 to get down to the 14.1. So when we do consolidating spreadsheets, you'll back out that 9.4 to get back to the amount of the subsidiary's income that the parent gets to retain as their own. And the difference goes into this NCI account. All right, dividends paid, they tell us that there was 5,000. Again, I can just copy down these formulas. 60% of it is the parents, and this should be a minus because that's going to reduce the NCI account. All right, so we can total that up. And they ask for what is the NCI at the non-controlling interest amount. So they're asking for the 31.4. Okay, they're asking for the 31.4. Now what they want to know is what the balance in the special machine and the trade secret will be on the consolidated balance sheet when it's reported. So let's do that. All right, so the special machine initially was 10,000, but now it's year end, and so it's going to be 9,000 on the subsidiaries books, and then we're going to increase it for the excess of fair value over book value. And since this is the end of year 1, we haven't done any prior depreciating. So we would put it on at that full 40,000. Next year it'd be 40,000 less that first year of depreciation that was taken, but we haven't taken any yet. All right, and then we would subtract out the amount that we depreciated this year. And so then we would add that up and get what the balance sheet for that machine will be reported on the consolidated. And then, of course, there was no initial book value on the trade secret. So we're going to do fair value over a book that was, there was no initial, it wasn't on the books. So the whole 10,000 will have to be put on during consolidation, and then you'll amortize that first year. And so the amount in the balance sheet for the trade secret after the consolidation is done. And thinking about the consolidation worksheet, you can sort of imagine in your mind's eye that horizontal line where you're going to make that consolidating entry, the A entry, that will establish that fair value over book value, that will add it on there during the consolidating journal entry. And then the D the E entry, the expense entry, where you're going to be removing the first year's depreciation from that. So you might be able to sort of visualize that. This is a vertical version of that horizontal presentation in the spreadsheet. All right, so we're ready for the next one.